Hello, assalamu alaikum everyone. Once again, Hussain Qazi here with you, day 5. I hope that you people are doing good. Can you please reply me about the clarity of my voice? Can you please reply me about the clarity of my voice? Hello everyone, assalamu alaikum. Very good. Voice is clear. Number 2, screen visualization also clear. Okay. Okay, candidates, now moving on to the today's session. Prepare to pass. Once again, assalamu alaikum everyone, and Bismillah Rahman Rahim with the last day session of FM P2P. I hope that you have got a very valuable insights about the exams, and we are covering a lot of things with respect to the financial management March 2020 exams. Now moving towards today's topic, connecting the matter with the previous session, that's about risk management. Yes, what we were discussing, the risk management. We were discussing the risk management about the foreign exchange. So to start the session with the topic of forex, means forex risk management, and conclude this topic accordingly, then we will move to the interest rate, and then to the briefing of the working capital management, and finally we will conclude the aspect with the more exam techniques to focus on the exams matter. Okay, so what we were discussed in the last session, we discussed with the last session that finance in the finance management is in the FM exam, there's a topic about the risk management, and the risk management related to the forex. And number one, what is the meaning of the forex risk, or the what particular risk the company faces with respect to foreign exchange? That is about translation risk, transaction risk, and the economic risk. And if the company has a plan to mitigate that risk, there are some internal and external strategies, and we have already discussed all these aspects. And after that, we discussed the aspect about the code important points with respect to mathematics, direct code, indirect code, how to identify the code is direct if the foreign currency is denominated, and code is indirect if the local foreign currency is numerator or local currency denominated. And after that, always conversion rate based on the bank. Furthermore, we have to think in a reverse manner, and with respect to the bank, lower rate belongs to buying, and then we move on accordingly. Then we have done some aspect related to risk management external technique, that's forward, and that's money market aspect, that's a matching principle. And now moving on towards the future contract, candidates do remember one important point: the examiner in FM will only examine with respect to the calculation about the forward and the money market. Other than that, examiner can ask all the aspects, including futures, options, or the swaps, only the theoretical aspect. Now, candidates, listen carefully. One more thing about the forward contract before moving to the currency options. One more thing about the forward contract. Examiner can ask something with respect to the calculation of the forward. Huh? Okay. Let's take an example with respect to the forward. Forward contract. Why the company need to make a contract with a bank? Because of the risk management. For example, there is a case, and the case is that our local currency is sterling, our foreign currency is US dollars, and the company has an exposure to make a payment of $1,000 after 2 months. And now, first, let's suppose 1st January 2019. Let's suppose there is a direct code. Sorry. Let's suppose there is a spot rate and a spot rate sterling over dollars. And let's suppose the rate is 0.77, only one rate. Only there is one rate. Or make it more simple, that's 0.80. Candidates, if a company wants to buy now dollars, answer me, how much sterling we need to pay now if we are going to pay immediately by lead payment? Please reply me. Yes, that's good. If the company wants to pay now, that has to pay 800. That's simple, $1,000 into 0.8 sterling per dollar. But the company has a risk that this is what the foreign currency, and the risk that foreign currency will move on, and after 2 months we have to pay more sterling for $1,000. That is the risk about dollar strengthening or sterling weaken, and have to pay more with respect to the sterling for $1,000. So we go to the bank, and bank has offered the forward rate. And let's suppose bank offered the forward rate of 0.85. Bank has offered the rate of 0.85. Now, I'm just I'm discussing about some very specific insight about the forward contract. If your examiner asks you in this scenario that forward contract is a legal binding contract, yes, number one. Number two, you have to settle this forward contract in any case, either the estimated spot become 0.9 sterling per dollar or 0.75 sterling per dollar. These are two different cases. What will happen if this scenario happens? Two different possibilities. Now listen carefully. You must have to know one thing very precisely, that spot market is different and forward contract is different. Spot market is different and forward contract is different. What does that mean? Let's suppose this is now situation, forward offer now, and estimated spot become case number one. Become case number one. What will happen? Now listen carefully. What will happen? Number one, if estimated spot after 2 months becomes 0.9 sterling per dollar, if this becomes the estimated, we will go to the spot market. Listen carefully. We will go to the spot market and purchase the dollar $1,000 multiplied by 0.9 sterling per dollar and have to pay 900 sterling. But we have to compensate from the forward contract. What to compensate? What to compensate? We will ask to the bank that we have decided $1,000 multiplied by 0.85 per sterling is equal to 850. 850. But we have paid to the market 900. So compensate with us. That's difference. That's difference. That's 50. That's become we will receive, or we can say that this is our gain. And effectively, the net payment we have to pay, that's equals to 850. That's 850. That means spot market is different and FRA is forward rate is different. Means forward contract is basically a binding contract to settle the difference between what will actually happen and the rate we have already locked. What if the estimated spot after 2 months become sterling 0.75 per dollar? Once again, we will go to the spot market and purchase $1,000 multiplied by 0.75 per dollar and pay to the market 750. Pay to the market 750. But we cannot get rid of, because we have to settle the forward contract. That means $1,000 with forward rate 0.85 is equal to 850. But in the market, the price was 750. That's 50 we have to settle. And this is forward loss and we have to pay. And effectively we have to pay 8 and effective, sorry, one moment. We have to pay 100 sterling, and effectively we have to bear the cost of 850. You can ask me that, sir, in both of the case, either estimated spot, unfavorable or favorable. In both case, the amount become 850. Yes, in both case, its amount become 850. That is what forward called the lock-in rate. That is called the forward call lock-in. Lock-in rate. You have locked the rate. What is the prime advantage of forward contract? Whatever the situation in the future, our position become cleared from the beginning. Our position now becomes clear or planned or pre-decided from the beginning. That is another advantage of the forward contract. This is very simple case. Like this, if we purchase the new car and we have a fear that in future, if we run the car, some accident may happen. So need to insure. If you insure the car for the 5 years, two possibility within 5 years exists. Accident may happen, accident may not happen. Accident may happen or may not happen. In both cases, if your car become insured, that means your situation is flat. Same like this. If you fix the contract with the bank, your position like fix. Number one. So in the case of forward, the chances of gain, chances of payment. But this detailed solution, you don't need to put in the exam. You have to work out the forward with the direct values. For example, if the examiner asks you, number one, what will be the estimated payment? What will be the estimated payment with forward contract? You will say simple. By forward contract, we have to decide it. We have already decided the rate of $1,000 with 0.85 sterling per dollar. So effectively 850 we have to pay. That is exam simple answer. But your examiner can ask you, listen carefully, if some estimated spot exists, that's 0.9, what will be the settlement amount as a gain or as a loss? If examiner asks you about gain or losses related to forward contract, then you will calculate this amount accordingly. Otherwise, no need. This one of the MCQ already examined with forward contract gain or loss. You people, what you do normally, or what you prepare, only one thing. How much the amount? This one. And you normally stuck with there. Okay, candidates. Next one. Next important thing about forward contract related to an MCQs. Same case. Same this one. If now spot is 800, 0.8, and you have developed a forward contract with 0.85, I'm going to ask a question. You just reply me true or false. If a company make this forward contract, so the company has already booked the 50 sterling as a loss with this forward contract, right or wrong? I'm just simplify. If the spot is zero, $1,000 exposure, forward is 0.85. So actually the company has immediately booked the 50 sterling per dollar. Immediate. Yes. You have already booked the loss. This is another MCQs. Whenever you make the forward contract in terms of payment, you agreed with the bank that I am ready to pay something more, but in future, if the situation happens or loss happens more than that, I will not tolerate. Or in the case of receipt, you normally book the rate of lower receipt, but in future, if the things happen more worst, I will not receive less than that. So this is another MCQs. I hope that you got this point. And now the next thing, that is the future contract. Listen carefully. Candidates, listen carefully. What are future contracts? Number one, futures are marketable standard contracts. Listen carefully. Yes, listen carefully. Number one, future contracts are also a legal binding contract, LBC, legal binding contract. But this is marketable standard contract. This is marketable standard contract. This is a marketable standard contract. First thing you have to know that, must bear in your mind, examiner will not ask any calculation about this particular topic. Do remember, huh? Number two, only theoretical aspect. Huh? Number two, about topic future contract. The essence of future and the forward are same. The essence of future and the forward contract are same. The difference is that forward contract are customized contract, future contracts are marketable contract. Let's take an example. For example, let's say the example, if you need to buy a shirt, you have two options. Number one, go to the shop of tailor and customize the requirement of your stitching, the print of shirt, the size of your body accordingly. One thing. Number two option, you go to the Oxford shop, you go to the next shop, you go to the Mark and Spencer shop and get the ready-made shirt. So when you go for the ready-made shirt, there are some standards. For example, if your collar size is abnormal, normally the gents collar size either 15 or 15 and a half. But let's suppose Mr. Hussain Qazi's collar size 15.75. That is mid. And Mr. Hussain go to the shop of the tailor, then no compromise. Mr. Hussain Qazi not expecting any compromise with the tailor. That is customized. But if Mr. Hussain Qazi go to the Mark and Spencer shop and ask them, give me the shirt size 15.75. What the shopkeeper will reply? Or for the Mark and Spencer or next, sir, welcome to the shop, but there is another gate. Please go outside. We cannot facilitate you. If you are agreed to adjust your knot, either take 15 or 15 and a half. So there are two possibility of contracts in the real world. Same case here. For the essence are lock the rate. The essence are fix the rate. In forward, the company hedge or fix the rate with the bank with customize. But in future contract, the company fix the rate, but with the market and follow the norms of the market. Number one, like forward, future is a legal binding contract. It may be possible in the forward there is a gain, there is a loss. Same case in future, there is a gain and the loss, but with the market. but the contract are marketable standard contract. Marketable standard contract means in term of nature of currency. For example, uh, you are situated at at England, local currency sterling, and you have an exposure for euro. So you will go to the bank and want futures for euro. If you have an exposure for dollars, go to the bank, go to the market and want the future of dollars. If you have an exposure of Dharam, Dubai, and if you go to the market and there are no futures of the Dharam, then you cannot do anything. That means the market is not available for the nature of the currency required. Number two, volume. Let's suppose exposure of dollars, and you want to make a protection of $17,000, but the future contract size is 5,000. You want the future contract of total 17,000. So 5,000, three contracts, 15,000, but 2,000 change is not available. So either you will get three contract of 15,000 bedding, means future contract, or four contract, means under hedge or over hedge. That's why, listen carefully, if you hedge for three contract 15,000, 2,000 unhedged. Unhedged means hedge inefficiency. Examiner already asked one MCQ about, is there a possibility about future contract hedge efficiency? The answer is yes, because we follow the norm of the market, and maybe possible some future contract we will buy and some remaining exposure unhedged. So nature, volume, and close out date. Candidates, future contracts are standard, and they are standard close out date. For example, this is 2019. March, June, September, December means future. You will enter with the future contract, and the market will run. If the market exists, your statement very important. If the market exists, not in the case of forward, in the case of future. In the case of future, market exists, so your contract may be sellable. Means you can buy your contract and you can sell anytime, but they are standard: March, June, September, December. Number two, how to select the contract. How to select? For example, now is 1st January 2019, and we need to buy $15 of March. So March contract will close at 31st March, June at 30th June, September 30th September, December 31st December. If my transaction date, what date? Transaction date 15 March. So nearest close out March. Once again, how we will select the shirt? Shirt nahi, not the shirt. How we select the contract? Contract will select based on the transaction date. If our transaction date is 15 March, so we will watch what is the nearest expiry date. Tell me, if we have the exposure of 5th August, what should be the contract? Answer me. If we need to buy dollars at 5th August, then we will take, very good, Nasir Khan, Ammar Ashraf, sorry. Very good, September. That's September contract. No, Nasir Khan, there is no July contract. Standard are March, June, September, December. Okay, that's good. Move on. Furthermore, there is a concept of future contract. Future contract. It's a very rare case, but the examiner, it's not in a very rare case. How to determine type? A clear difference between the future and forward contract is this. Future contract is saleable. For example, if we enter a contract with the term buy dollars, now in future, if we wanted to sell this contract, so we will sell dollars later. If we enter in the contract buy now, we will close with sell later. And if we enter sell now, we will close with buy. We will close with buy later. So any contract, if we purchase now with the name of buy, it will close in the future by the name sell, and it's tradable. If we enter with a contract with sell now, we will close with the buy. Very simple. Let's suppose there is an application in your country to buy and sell your car, or buy or sell your property. Buy or sell your property. For example, OLX. We can enter in OLX market either to buy the car or either to sell the car. Either to buy the car or either to sell the car. So it depends what we need. If we are entering in future to buy something, means we are entering to take the contract buy now. Future, close with sell. Same case, we can enter in the market to sell our car, but in future by name sell, but we will close the contract by name buy later. Candidates, actual thing you will get at AFM. A little bit theoretical aspect required for FM paper. That's all. You need to know about the difference between forward and futures. That's very important. Now, candidates, next one. Listen carefully. What are options? What are options? One side, forward and futures. Another side, option. Another side is option. Candidates, are you getting the point what I'm saying? I hope that you are getting my wordings, what I'm saying. Be with me. I hope all of you people are with me. All of you people are with me. Yes or no? Be with me. Okay, candidates. Next point. Next point. The essence of forward and futures are same. Essence means, let's suppose you have an exposure to buy or sell the currency in future. You go to the bank or you go to the market and fix the rate. That's fixing the rate, candidates. That's fixing the rate. It's called forward or futures. If customize, forward. If marketable, that's future. Now, entirely different concept. First, you need to develop the essence. What is the meaning of option contract? Option contract. Option means if you are an exposure, listen carefully. Now the rate sterling 0.8 per dollars. For example, bank has offered you the rate is sterling 0.9 per sterling. Oh, sorry, per dollar. So what do you think? If since now actually dollar strengthen and sterling weaken in the spot market and go for the forward, I will get the gain. Once again, you have an exposure to buy the dollar 2 months after, and this is forward rate bank is offering. Whenever bank is offering, what you are thinking, if actually dollar become strengthen and sterling become weaken, means this is actual happen, you will get the gain. But what if you lock the rate, something's going here, I mean in the future spot market the rate becomes 0.6, then you will get the loss. So as a contract holder, what I use the term candidates holder, the term use holder. As a contract holder, you wanted to enter with this contract but avoiding this loss, avoiding this loss. Based on this, avoiding the loss, based on this to avoiding the loss, there may be the contract by the name option. So option contract means the holder of the contract have an advantage to get the gain but not the possibility of the loss. Tell me, how is this? It's good or not? As a holder, leave it, the front party, the bank, leave it. It's good, very good. But in the finance world, for any of the benefit, against the benefit, we have to pay some sacrifice. If, for example, go to the bank and bank reply the forward contract, and we reply, no, not forward. We want option because we want only gain, not the chance of loss. Then the bank will say that, yes, you can get the option, but have to pay the premium now. Have to pay the premium now. So number one, option contract is a contract where the company can get the advantage only, but not the disadvantage. That means the loss, not the loss. Means there is a wording, the downside risk is eliminated. This is the wording of book. The downside risk become eliminated. Downside risk become eliminated by paying the option. You have to pay the premium now. Upfront premium, upfront. Important point. Currency options also two category. It's OTC and marketable standard contract. Number one, our position as a contract holder, and contract holder pay premium, upfront premium. And if you wanted to go for some buy contract, any buy contract, so the terminology you can use buy call option. Buy call option means if you enter with the contract to buy the dollars, for example, so you have to buy the call option. And if you have an exposure to sell your currency, so at that point you will buy put option. Buy put option, buy call option. Buy put option, buy call option. Call means to buy something, put means to sell something. Call means buy, put means sell. If you have an exposure to buy some currency, so you will enter with the option contract with the name call option. If you enter into contract the sell, having the exposure of sell, then you will purchase the put option. So candidates, that is the point. Furthermore, we will furthermore, if the examiner asks you the difference between option and futures, or option or futures, there is a clear difference. As an holder in option contract, we have to pay premium now, but in futures or forward, no need to pay immediate payments except deposits. Leave the deposits. And in the books, the deposit name is margin. Deposits is a security money. Leave it. Otherwise, in forward futures, immediate no payment, option upfront premium. Number two, option premium is a disadvantage of option as well. That is the advantage of forward comparison. In the future, option has an advantage, that's contract holder has no exposure to get the loss. But the future contract, there is a chance to get the loss. Same for the forward. Okay, let's move. That is what about the forex aspects. Now it's time to discuss something about the interest and then move uh, for more things about the working capital. Let's take a small break. I will discuss the matter of the swap later on, currency swap later on with the interest. 3 minutes break. Take energy. 3 minutes break. Thank you. Hello, hello, hello. 3 minutes now over. Okay, candidates. Now move on for the another topic. Move on for the another topic, and that is about interest rate risk management. Interest rate risk management. Candidates, the most important thing about the risk management is that what is the meaning of the topic? What does that mean? What is the meaning of the topic? We are discussing the term risk management, but as in a business context, what risk the company are facing related to the interest rate. With reference to the business context, with reference to business context, what risk the company are facing? Definitely, the risk are facing, and you must have to think in that manner. What I'm going to say while next 30 seconds. Number one, if I'm a company and I wanted to make borrowing after 2 months, need to borrow. So what the risk? Interest rate will increase. Or if after 2 months some spare fund will available and I want to lend the money, so what the risk? Interest rate will decrease. So what will be the risk? The risk as a borrower or risk as a lender? More depth required. In the business context, borrowing or lending, it may be possible marketable or non-marketable. For example, non-marketable, we go to the bank, and borrow the amount or lend the amount. That's a risk. For example, after 2 months, I need to borrow some amount. For example, $1 lakh for 3 months. So I have a risk that after 2 months, LIBOR will increase or interest rate will increase, and I will get the loss. Same case with respect to the lender. If as a lender, I know that after 3 months, I will get some spare fund for temporary basis of 4 months. So I have a plan to lend that money after 3 months. So what will be the risk? When the funds available after 3 months, interest become reduced and I got a loss. But the candidate, the very important point, you have to develop your mindset related to risk of the marketable debts. Respect to marketable debts, as a borrower, after 2 months, I need to borrow the money and wanted to sell the bonds. I'm a borrower, huh? Sell or issue the bonds in the market. So you have to think in that manner as well. Once again, after 2 months, if for example, there is a bond now 100 rupees, and now the spot rate is 5%. If I wanted to borrow the money after 2 months with same 100, with same 5%, And I'm expecting then in the market, the government will increase the rate of interest. The government will increase the rate of interest. So what will be the risk? The risk will that the bond I'm going to issue in the market, the value become reduced. The value become reduced. Whenever we are going to sell the bond, my existing bonds become reduced. You must have to clear very much important point, the relationship between interest and bonds valuation is inverse. Is inverse. If interest rate increase, value of bond in the market become decrease. Do you agree that? It should be. For example, you are you are a company. You are a company, and current rate of interest 5%. If you issue, sorry, and you wanted to issue that bond in the market, but after 3 months, rate of interest increases. Let's suppose 6-7%, but you still want to issue the bond with 5%. What will happen? Is the investor will buy with the same value 100? No, your return of 5% is lower than the market rate, 6-7 whatever. So if you even wanted to sell the bonds, the value of bonds become reduced. The bond will not sell by 100, that will be less than 100. Candidate, same point with respect to lender. Same point with respect to lender. As a lender, I know that after 3 months, I have some spare fund for $100,000 and I wanted to buy the bonds. I wanted to buy the bonds. So once again, what will be the risk? If in the market, if in the market, interest become increases, sorry, interest become decreases, the value of that bond become increases. Once again, the lender has a risk that when go to the market and wanted to lend the money, interest decreases. Yes, interest will decrease, and effectively the value of that particular bond that I'm going to buy become increases. So candidates, in simple word, make up your mind. Whenever you start study this topic, interest rate risk management, first of all, you have to think what's the risk, business context, and the interest. You have to develop your mind in two ways. Number one, non-marketable. Number one, marketable. Marketable, simple. As a borrower, we are going to make a transaction of borrowing, the interest become increase. Lender decrease. But marketable, if we are going to issue the bonds as a borrower, so it may possible interest rate increase and my bonds become, value of the bonds become decreases. In the case of lender, I will get some spare money in future. What will happen? Interest decreases and the market's bonds become increases. Candidates, are you people with me? Yes or no? Reply me. Hello, hello. Yes, yes, you are breathing. That's good. That's good. Oh, lender, what the lender wants? What the lender wants? Lender wants to invest the money. What's the risk? whenever go and invest the money, at that point interest decreases. Interest decreases, and in the market, bond become expensive. Bond become expensive, and if the things become expensive, so as a lender you will get the loss. That's the point, Taimur Saab. Okay, so the important point is that, listen carefully. The important point is that what are the interest rate risk management? What are interest rate risk management? Interest rate risk management can be made by internal strategy or by external. Internal matching, internal smoothing, external FRA, external internal interest rate guarantee, external internal rate futures, external interest rate future options, external collars, external swap. These are the technique. Now, what will happen? Listen carefully. What are the internal technique? Candidates, you know very well before starting this topic, you know very well. If I am borrower, only think about the borrower now. If I'm a borrower, I can borrow the money, either the fixed rate or floating rate. Fixed rate means, for example, there is 3 years time, 1 year, 2 year, 3 years. I wanted to borrow the money. Fixed means have a flat the rate with a certain percent. If the market moves, it's not affect. That's a fixed rate. Market means interest rate in the markets. Number two, floating rate. Floating rate. What does that mean? You borrow the money, but the interest rate fluctuates and you have to pay accordingly. That means you are getting the exposure of the market, risk, fixed and floating. Now, for example, today is 1st January 2019. Today is 1st January 2019. And I wanted to borrow the money. Sorry, today is 1st January 2019, and we are here as a board meeting to work out for the interest rate exposure and mitigate the risk. So, group companies are all together. For example, we have a group companies for 7 companies. One of the companies say that after 3 months, I want to borrow $100,000. Another company says that we need to borrow after 3 months. Sorry, we need to lend after 3 months. Lend, not borrow. Lend $70,000. Both are arguing either fixed, either floating. either fixed, either floating. So that means that's now after 3 months. This is borrowing, that is liability. This is lending, that is asset. Lending, liability and asset, that's match. And match net figure become 30,000. Net figure become 30,000. Net figure become 30,000 candidates. So that means if after 3 months, if interest rate increases, so borrowing point of view, loss, but lending point of view, gain. So net we and vice versa. So net we have the exposure of 30,000. This is what internal technique. This is what internal. That is called matching. Now, candidates, another point. 1st January 2019. Listen this point carefully. 1st January 2019. And listen this point. We are worried about the movement of interest rate. We are worried about the movement of interest rate. And we have already borrowed two different amounts. For example, 100,000 with the fixed rate. And let's suppose 60,000 with the floating rate. Both are borrowing. And we have actually take this borrowing for, let's suppose, next 7 years. But we have an expectation that over the period of time, interest rate will increase. Over the period of time, interest rate will increase. If actually interest rate increase, so we will make a loss on floating, but no effect on fixed, means gain on fixed. Gain means no impact. Market rate increases, but having no effect. If interest rate decreases with respect to fixed, as a borrower, we got a loss, but floating as a gain. This positioning is called smoothing. This position is called smoothing. Smoothing is an internal hedging technique, but with respect to borrowing, fixed and floating. Borrowing fixed, borrowing floating. Lending fixed, lending floating. But internal technique matching, that must be matched out with borrowing and lending with inverse relation. That is the point. That is the point. That is what the internal technique. Now, FRA, as a borrowing, we are discussing as a borrowing. Listen carefully. Listen carefully. Borrowing. FRA. It's a future contract. It's already discussed. Like Forex. Legal binding contract and over the counter. Over the counter in term of amount of borrowing or lending, whatever amount, timings. We have to borrow for 3 months, 6 months, 8 months, whatever timings. Borrow or lending, whatever. FRA may be different from the spot, and we can get a loss or we can get a gain as well. Let's take an example. For example, today is 1st January 2019. Today is 1st January 19. Spot is 6%. And I have to borrow the amount after 2 months. 1st March 2019 for 6 months. Over the counter means OTC, customized contract, customized, tailor made, not marketable. Spot is 6%, and I have a risk that after 2 months, when I'm going to borrow the amount, and this amount is $100,000, I have a particular risk. What is the risk here? Spot 6%. That at that point, interest rate become increases. So bank has offered me the FRA of 7%. Is this the lock rate? Yes, this is it's a lock rate. It's a lock rate, candidates. After 2 months, if I opt the FRA contract, I have to get the amount. Sorry, I have to pay the amount with the 7% into 100,000 into 6/12. It's fixed, predetermined. But how it works, very important. Recently, examiner has examined. It's not only FRA. What is that point? Number one, if estimated spot, what will happen? Become 8% or become 5%? This is analysis. Do remember, forward rate, it's a separate agreement, spot is separate agreement. Number one, we go to the spot market and take 8% and settle with FRA. FRA set means FRA settlement with 8% minus 7%. 8 is the spot and settlement 7%. This 1% become gain. That's receive. And the effective rate 7%. If EIR, effective interest rate. Now second case, we go to the spot market, take 5%. FRA settlement, book the rate with the 7%, 5 minus 7. That's 2%. And here 2%, we have to pay loss to the bank. And effective interest rate 7%. In recent examiner already asked, sometimes if in both case, what will be the borrowing cost? 100,000 into 7% into 6/12. That is $3,500. If your examiner asks, what is FRA? So you will mention FRA at the rate 7% with the date after 2 months for 6 months. That called 2-8. After 2 months for 6 months, that is called 2-8. After 2 months for 6 months, that is called 2-8. Answer me. If after 5 months for 4 months borrowing, what will be the rate? What will be the FRA? After 5 months for 4 months, what FRA? Answer me. That is 5-9. Here 2-8. Now, how the examiner can examine? If examiner asks you, this is FRA 7%, borrowing, what will be the borrowing cost? Either interest rate increase or decrease. Your answer will be straight. FRA, this one, $500,000. If examiner asks you, if the estimated spot 8%, what will be the gain? This one. Becomes 5%, what will be the loss of FRA? 2%. Examiner already examined this one. Gain loss. If say what is FRA, you will say 7% 2-8. If examiner say that, answer me. If you immediately develop the FRA, what loss you are immediately booking? You will say 1%. $1 lakh, 6 months. That means 500 or 1%, 6 months proportion. By FRA, you will get immediate loss accordingly. That is the point of FRA. Legal binding contract. Number 2, this is over the counter. Only theoretical aspect we need to discuss here other than FRA. Examiner will not ask the calculation. One thing is interest rate guarantee. That is called, for understanding, FRA option. FRA option. Interest rate guarantee, FRA option. What does that mean? FRA option. The spot 6%, FRA 7%. Spot 6%, FRA 7%. In the case of interest rate increase, you will get the gain, but decrease, you will get the loss. If you wanted to avoid the loss of FRA, you have to pay immediate premium. You have to pay upfront premium. It's also OTC, over the counter contract. That's all. Examiner will not examine the question. Another important point, very important. Interest rate futures. Interest rate futures. Now listen. Number 1, the essence is like FRA, but here the company as a holder contract with market, not with the bank. Company will contract with market, not the bank. This is the marketable standard contract. This is a marketable standard contract. First thing, marketable standard contract. Once again, marketable standard contract in term of timings. Same, the contract close out date March, June, September, December. Timings. Marketable standard contract. Timings. And amount. Amount means contract size. You need to borrow after 2 months $100,000. So you wanted to enter with a contract of $100,000, but the future contract available each $50,000. So you have to get 2 contracts. You have to get 2 contracts. Number 2, it's a legal binding contract. LBC, legal binding contract. It's a legal binding contract. That is important, huh? Legal binding contract. You cannot withdraw. You can get a gain as well as loss. Compensate by In case of gain, compensate by market or compensate to market in the case of loss. As a contract holder, listen here, and you are borrower, the type, I'm type borrower, sell now, buy later. Listen carefully the depth of this point. Listen carefully. As a borrower, what is the risk? Tell me, as a borrower, in future, what is the risk? Interest rate become higher. Yes, be with me, candidates. Interest rate become higher. If interest rate become higher, bonds value become decreases. If you wanted to borrow the money, interest rate is higher. That means bond value become decreases. Bond value become decreases. So what the business model says, business model, if in future some product, some assets value become decreases, you as a fair. So what is the business model? Sell the asset now, and in future when the price decreases, buy later. If the examiner asks you what is the type of contract futures, you will say that borrowing case, we have a fair bond will decrease, so sell now, buy later. In case, listen carefully, in case lender, think about the risk, interest rate become decrease, bond value become increases. Bond value become decreases. So if we have a risk that bond value become increases, so what is the business model? If you have a property or any asset and you are expecting that, sorry, if there is a property, there is a property in the market, not you have, in the market, and there are the chances that value become increases. What to do? What to do? Taimur Sardar, buy now, sell later. This is the clear case borrowing and lending. This is all about this static. That is interest rate futures. No examiner will or not ask you about any calculation. Interest rate future options. Interest rate future options. Candidates, listen carefully. Interest rate future options. This future options. Number one, what is the meaning of option? Option means as a contract holder, you want, what do you want? You want it to avoid the chances of loss. So as a contract holder, if we go to the market, number one, to the market upfront, premium. Number one, upfront premium. Number two, very important thing. Listen carefully. Type of contract. Type, it's based on either you are borrower, either you are lender. If you are a borrower, so listen carefully. Based on this future contract, sell now. Sell now. Based on this sell now, you will have to buy put option. The exact relation is this: borrower risk, interest rate increase, bond value decreases. So sell now. Sell now means as a contract holder. As a contract holder, we have to buy put option and pay upfront premium. And last point, if we are lender, listen carefully. If we are lender, so we have to purchase the contract that bond value become increases. So that's now buy now sell later. Buy call option. Candidates, actual details will be discussed with AFM, not this part. Only theoretical aspect you need to cover. That's all. That's all. Candidates, what are the benefit of option? Number one, options are interest rate future options. Interest rate future options. Do remember. Interest rate future options. Number one, these are interest rate future options. But the important point is that these are interest rate future options. The benefit is this: as compared to futures, contract holder don't have a chance to make any loss. Listen carefully. Don't have a chance to get a loss. But on the other hand, the drawback is premium. But if we wanted as a contract holder, listen this point, if we wanted to get the option as an option holder, either put or call, but to avoid this premium or to minimize this premium, then there is a concept called callers. Number one, why callers arises? Because wanted to minimize this premium, and a little bit knowledge about the callers you required. A little bit, not in detail, a little bit about the callers. What is the reason of caller? Why caller arises? If examiner asks, to minimize the cost of interest rate future options premium. That's all. This is what initial required. Candidates, please, next 2 to 3 minutes is very technical. Be with me. In the case of borrower, listen here. In the case of borrower, number one, you are a contract holder of put option. Are you with me? Please reply. As a contract holder, you buy the put option. Are you with me? Yes. And you know very well, there are two parties in the contracts, either future, forward options. There are two parties in the contract. In the option contract, we are holder, but in front of us, second party is bank or market, whatever, are the writer. Writer. This is important. So in the case of holder, we have to pay the premium. Do you agree? But in the case of writer, we will receive the premium. Holder will pay the premium. Writer will receive the premium. I hope you people are with me. Okay, now number one, spot 6%. Listen carefully. Spot 6%. MCQs may arise for this. Listen carefully. Free marks for this. You just focus this, you can get the marks. Spot 6%. You are a borrower. You have a risk that interest rate will increase. And you go to the market or bank, you will buy put option of 7%. And you have paid premium. All of you are with me? Please reply. If you buy put option, buy put. So actually we can also say set cap. And your position as an holder. Your position as an holder. Now you wanted to minimize this premium cost. Be with me. So at same time, reason ignore. I'm just talking how it makes, and that's it. That is what the expectation of examiner. At the same time, if you want to pay, reduce the premium, you sell the call option, for example, 5%, and set the floor, and you must become a writer. And in case of writer, you will receive premium receipt. And now your premium become net. Net becomes zero, net become receive, or net become low payments. Candidates, you don't need to go in depth. Three things you need to know about caller. Number one, why caller arise? To minimize the cost of interested future options premium. How the case of borrowing, do remember this point. Buy put, sell call. Buy put means set cap, sell call means sell floor. Overall premium reduce. Now candidate, last point. In the case of lender, ignore borrowing point. In the case of lender, for example, spot is 5%. What you have a risk? You have a risk interest become decrease. So in case of lender, we buy the call option. I'm not asking about callers. Buy call and pay premium. Buy call, pay premium. For example, call 4%. And you have paid the premium and actually set the floor. And you are contract holder. You wanted to reduce this premium. So at that point, you need to develop the callers. How? You sell the put at the rate, for example, 6%, and set the cap and become writer. Once you become writer, the premium will receive, and your overall premium become reduced. You just need to know about, as a lender, in the callers, you buy call, sell put, and premium reduces. Set cap and set floors. You just take up this, and that is callers, nothing else. Minimum. Buy put, sell call, borrower. Buy call, sell put, lender. That's all. The calculation will not examine. Don't worry. The calculation will not examine. Not to worry about it. Candidates, one more thing. Swap. Now listen carefully. We have done risk management, forex, interest with all short-term aspects. With all short-term aspects. But if there are some risk about interest, about forex for long-term aspect, then we use the term swap. So swap is a risk management strategy for longer game. For example, interest rate swap. Interest rate swap. Very simple. Interest rate swap. There are two parties. Examiner will not examine the calculation. I'm just giving an example to understand the things. There are two parties. Let's suppose both have already borrowed. They have already borrowed 10 million, 10 million. Interest rate fixed, floating, and time period 5 years. Both party. But A wanted to shift from fixed to floating, and B wanted to floating to fix. Again, I am A, you are B. Both have taken a loan, already taken 10 million, $10 million for 5 years, 5 years. But I have taken fixed, you have taken floating. I wanted to move for any reason from fixed rate to floating. And you wanted to move from fixed to floating. We don't want to repay the loans. We want to maintain the loan, but need to exchange. What I have used the word exchange. Exchange the interest rate. So swap, the term swap means exchange. Means exchange. Fix the rate in interest rate swap. Do remember, actual principal will not exchange, but interest rate fixed to floating, floating to fixed become exchange. And where if A and B exist, so where A and B meets. One possibility on the Facebook, anybody in my inbox? No, no, not at all. Definitely the middle is bank. The middle is bank. The middle is bank. Bank will come and join this bank. I will go to the bank for the swap. B will also come to the bank and also swap. And then bank will uh, set the meeting for this swap and impose the charges to both A and B. Yes, the amount may be different, 10 million, and maybe possible I've taken 12 million. So definitely the swap arrangement between the common amount. Timing 5 years, 10 years. So definitely timings of swap with a common amount. That is interest rate swap. So this is possible. Yes, candidates, some more thing you need to know about risk management. About risk management, some more thing you need to know. And you need to know about number one, exchange rate fluctuations. But why? There are four things you need to consider. Because of the limitation of time, I will discuss the matter very quickly. Two countries' exchange rates are not same. Why the sterling and dollar rates are not same? Why the euro and the dollars rate are not same? People, are you with me? All of you are with me? I hope so. Why both are different? Number one, purchasing power parity theory. And through purchasing power parity theory, we can estimate the exchange rate. Estimate the exchange rate. But for long-term purpose, do remember, maybe for short term, but normally long term, NPV, for this purpose. And there's a formula, very simple formula. Estimated spot S1 is equal to now spot S0 S dot multiply by 1 plus inflation, 1 plus inflation A divided by 1 plus inflation B. A or B depends how the rate's given. What's the numerator and what denominator? I'm not asking direct and indirect code. I'm just saying what's the numerator, what's the denominator. So S1 estimated spot, now spot inflation A, inflation B. We can determine the estimated spot, or the examiner can twist. Estimated spot given, inflation given, both determine current spot, or estimated spot, current spot, one inflation, need to identify another inflation. And it may be possible the game is not 1 year, 2 year, 3 year, maybe for 6 months after. Possibility. Number two, interest rate parity theory. Interest rate parity theory. Interest rate parity theory is about a question: how bank offer the forward rates. How bank offer the forward rates. So F naught is equal to forward rate is equal to spot 1 plus interest A 1 plus interest B. So bank can offer the forward rate by this, and this is interest rate, for example, per year and a portion as well. 3 months, 6 months, whatever. 3 months, 6 months accordingly. So this is the point. And you can even, examiner can twist you for different aspects. Maybe to identify forward and giving all variables. Maybe to identify interest A or B by giving all other variables. Interest rate parity theory have a mindset that interest rate parity theory having the mindset, and the mindset is that spot rate fluctuates with the reason of interest. Purchasing power parity theory, the two exchange rate differences due to the reason of inflation. So theory is very important. And A or B, the formula denotes yes. For example, America, US, UK. So in the case, the currency given sterling over dollar, so sterling A, dollar B. Dollar over sterling, dollar A, sterling B. So it depends. One very important theory, that is Fisher's effect. And you have already covered with the investment appraisal. And it says that the returns of the investor that's nominal return, it's based on this formula of any country. And you must have also refer the term international Fisher effect with the book. You have to refer. And based on this principle, four-way equivalency theory. Four-way equivalency theory. You must have to refer for the book related to four-way equivalency theory. And due to the shortage of time, I cannot put in depth about it. In fact, not in details right now, because I have to cover the working capital as well and other aspects as well. I will share a short video about the four-way equivalence theory with the MCQs on the WhatsApp. A little video, a small video, maximum 10 to 15 minutes. You can watch from there. Examiner can ask you accordingly. In the meanwhile, you can work out from the book. Candidates, some more thing you need to know about the risk management is that very important something. If somebody asks you the term basis risk, what is the meaning of basis risk? So you have to reply very straightly. You have to reply very straightly about the term basis risk. What does that mean? Number one, risk means if we are something predicting, and the things according to prediction, this is not the risk. The risk about that risk is what? The things is not according to prediction. In case of interest rate, basis risk means interest rate moves sorry interest rate of deposit means lending and borrowing moves by different way. Means if borrowing rate increase and interest rate also increases, but this is our prediction, but this is not exactly move. That's the risk. And in case of forex, if examiner asks what is the meaning of basis, is one simple thing: there is a rate of spot and there is a rate of futures. Rates of spot and futures moves in different way. In a different way. Spot rate and futures market rate not move in a parallel manner. If they moves in a parallel way, what does that mean? Whatever you predict about the futures rate, the things are going on accordingly. But the risk is that rates are not given accordingly. Amar Ashraf, whatever the statement you mentioned, gain loss on the future contract may fail to offset change in rate that is known as basis risk. This statement is more perfect about inefficiency of hedging. That means imperfection. This statement is more about imperfection, that's uh, inefficiency of hedge. Okay, candidates. Furthermore, one very important thing you have to know about that, you have to cover, we have to cover this, a quick matter. Number one, some theories. Number one, what is the meaning of liquidity preference theory? Liquidity preference theory means in a very simple manner. Investor, all the investor loves the most of the thing in the life, that's the money. If the money, if the money or the amount is far, as the far, you have to compensate it. Very simple means the most preferable term for the investor is the liquidity. As the maturity become longer, you have to be compensated accordingly. So in simple word, liquidity preference theory says investor need to be compensated if the maturity become longer. That is liquidity preference theory. Number two, expectation theory. Expectation theory. Candidates, before discussing the term expectation theory, very much important thing you have to consider. Let's assume that you are an investor. Focus on your mind with respect to investor. You are investor. You are an investor. And there are two possibilities to invest your money in the bonds in the market. And you wanted to in the market for 2 years and interested to invest in bonds. So there are two categories of bonds. One, long dated. Number two, short dated. Short dated bonds means government issued some bonds for 3 months. Banks issued some bonds short dated 3 months, 6 months, 2 months. Long dated bonds, 5-year bonds, 4-year bonds. As an investor, if you are expecting expectation that interest rate will increase, if you are expecting that interest rate will increase in the near future, will you buy the long dated bonds now? Answer me. Will you take interest to buy the long dated bonds now? No, never. If you are feeling that interest rate will increase in future, you will play the game with the short dated bonds. And if you are expecting that in future interest rate will increase, interest rate will decrease, so you have to go for the long dated bonds now and ignore the short dated. So collectively, if investor expect that interest rate will increase in the future, right now short dated bonds become increases. Right now short dated bonds value become increases, and vice versa. So what expectation theory says that? Expectation theory says that investor in the market having some expectation based on the trend of interest. If the trend of interest is upward, so actually short dated bonds value become increases and long dated bond value become decreases. And you can think this point in a reverse manner. Reverse means if you feel that as a finance manager, short dated bonds in the market has become increasing, that means there is expectation that some interest rate will increase in the future. An examiner can ask you this statement. This is right or wrong? If short dated bonds value market in increasing trend, so there is an expectation that market rate of interest in future become increases. And very important thing, market segment theory. Candidates, what are market segment theory? Candidates, there are two categories of investor in the market. One is public and other is institutional investor. For example, banks. For example, pension funds. For example, banks, pension funds. So market segment means bank is also giant, huge, and pension funds companies are also huge. Brokerage house also huge. Majority times, all the institutional investor, banks, pension funds, brokerage house having same expectation, but sometimes they are segmented. Segmented means bank has different perception, pension funds different perception. So sometimes interest rate perception having some glitch or wiggle. It's a wording of book, wiggle. Some differences. It may happen. So you examiner can ask you like this: interest rate expecting a wiggle, or March June 18 questions, a term was used that's not kick. I'm sorry, kink. That's discontinuation. That's also the result of the segmental aspects. Now I'm going to repeat these points in this manner. There is a topic that's called yield curve. Yield curve. Yield curve means interest rate curve. And these are government risk-free government bonds, government interest rate. It's a company's interest rate as well, may be possible, but it's not the course. It's in your course yield curve about government, a complete economy policy. Normally, yield curve are increasing trend. So now study these things with these contacts. Discuss why the yield curve, that is time and return. And this is all about debts. Why the yield curve upward, normally upward? Because of number one, liquidity preference theory. As the maturity times up, return rate upward. Number two, upward expectation theory. Number one, investor expectation interest rate increase, or short dated bonds in market is high demand. So that means interest rate increasing. Or major expectations of the market segment, that interest increasing, that's upward. But sometimes, or when it downwards, when it inverts, number one, downwards, it's abnormal situation. Number one, first thing, when the expectation about that with respect to the market, that market value of long term bonds become increases. If the market is like this, long term bonds increases and short term bond decreases. So that means expectation is that the downward. This is a very inverse situation. Normally it's not happen. And sometime it may possible that this is clutch. Nobody knows where moves. That means having different expectations. That's market segment aspects. You have to refer the book as well. Candidates, this is March June 19 question. We have a very limited time to discuss this point. I'm giving you a few minutes to please attempt this question. You must read it, the question once. You must read the question once, please. March June 2019. Yes, Peony Company Finance Director concerned about the effect of future interest rate on the company has been looking at the yield curve. Candidates, normally before March June 19, we observed that, and you can take the questions as well, previous questions and revision question, risk management having one type question, either forex, either interest. But the examiner has examined in March June 19 a mixture having the interest and forex as well. Okay, Peony Company, number one, Peony's company finance director concerned about the effect of future interest rate company and looking at the yield curve. Peony company use domestic currency dollar, plans to take out $100 loan in 3 months time for a period of 9 months. Company concerned about interest rate might rise before the loan taken out, and bank has offered 3 versus 12 FRA. The loan will be converted into pesos and invested in the 9 months, which is expected to generate income 580, 200 million pesos 6 months time from today, 380 million pesos 12 months time, current spot rate given. Following information short interest rate. As a result of general uncertainty over interest rate, Peony considering a variety of ways to manage interest rate risk, including use of derivatives. Can you answer the 26? In relation to yield curve, which of the following statement is correct? Expectation theory suggests that deferred consumption requires increased compensation as maturity increases. This is not about the expectation theory. Deferred consumption requires increased consumption, maturity increases. This is all about, we can say, with the liquidity preference, not the expectation. So that's why this is wrong. An inverted yield curve can cause by government action to increase long-term borrowing. Increase long-term borrowing. No. If government want to borrow, that means invest the money, and investor want to go for the long term. No, government does not want. A kink discontinuity in the yield curve can due to differing yield in different segment markets. Is this the right or wrong? Please reply me. C statement. A kink discontinuity, normal yield can be due. Yes, due to market segment theory. There is a rift between the different segments. Pension funds different segment, bank different segment, different rights. So that's discontinuity. This statement is right. Basis can cause the corporate yield curve to rise more steeply than government yield curve. No, this is not the reason of the yield curve. Candidates, this 27 question, I'm not calculating, but just discussing how examiner examined. If interest rate on the loan is 6.5 when taken out, do you know what this means? 6.5% when taken out. This is estimated spot. Upper the complete case. Here the estimated spot. What is the nature of compensation payment under FRA? What examiner is asking here? Don't calculate. Just tell me what examiner is asking. Just tell me what examiner is asking. Candidate, here examiner is not asking calculate the amount of FRA. No, here asking you can get gain or loss. If you gain, then bank pay to peony. If you lost, peony pay to the bank. So you have to calculate the FRA situation as we have already done. Either the gain or loss. If the loss, if the point loss, then peony pays to the bank. If gain, anyone you need to calculate. Otherwise, bank pay to the peony. That is the point. So first try to understand the question, what examiner asking. I haven't conducted the sessions in a rote learning manner, with the conceptual manner, with the expectation of the examiner. I hope that you people agree with this. 29th point is about interest rate risk, that is smoothing and matching. You have to read and work out accordingly. And then the derivatives. This derivative, can you reply me the answer of this one? In relation to use of derivative by peony, which of the following statement is correct? Yes, reply me. Be participative, candidates. Please be participative. Just tell me right, wrong. Just tell me right, wrong. Don't make fair. Everybody here is to prepare something. In you relation to derivative. Derivative means external hedging. Which of the following statement is correct? Number one, interest rate options must be exercised on expiry if they have not been exercised before then. This is the wrong statement. Why this is wrong? As an holder, interest rate option not compulsory, must be exercised is the wrong statement. That is wrong. They only can hedge interest rate risk by borrowing, selling the interest rate now, sell now, and buy back in future. Sell now, buy later. Is this right? Borrowing is right. I, if you read the question, they need to borrow, take out, loan, borrow. So what we have studied with the futures, sell now, buy later. Yes, sell now, buy later. This is right statement. Interest rate swap is an agreement to exchange both principal interest. This is right or wrong? If this is right, why it is right? If this is wrong, why it is wrong? This is wrong because interest rate only consider interest, not the principal. Only interest. Swap, exchange, only interest. Peony company hedge interest rate risk, borrowing, buy floor, sell cap. Buy floor, sell cap, borrow. Yes. What is the borrow here? Buy put means buy cap, sell floor. So this is wrong. Peony can hedge the risk on borrowing, buy floor, not buy cap, sell floor. That's why wrong. Candidates remaining after the practice to pass session. If you just practice the things of the past paper, limited past papers, and one kit with this element of quality, there's something right, why it is right, something wrong, why it is wrong, then inshallah you will qualify. Candidate, that is what done with the risk management. I cannot spare more time about it because I have to spend at least 1 hour for the working capital and the exam technique, more as revision of the exam technique aspect, what I have discussed with you. Candidates, I hope that you got enjoyed with this session of the risk management. Yes or no? I hope that that's value for you about the session. Take a 3 minutes break. Take a 5 minutes break. 5 minutes break. Then I will start the topic of the working capital management. Remaining question you have to attempt at your own. Working capital management, and that is 5 minutes break. Hello, everyone. The break is over now, and the topic is working capital management. Hello, can you please show me your presence? Hello, hello, hello. Okay, let's move. Candidates, one of the topic that is called working capital management. I can give you a quick briefing about this topic because we don't have enough time for details. But if you wanted to ask any type of question, including FM P2P, FM March 20 exam, including working capital as well, anyone, you can ask me on the WhatsApp group. You can ask me on the WhatsApp group anytime before the exam. But this offer is valid just for March 20 FM exam. No, you can contact me after that as well. Okay, candidates, working capital management. Number one, do remember very important point. Um, the exam scope about this question, about this topic is 20 marks to 25 marks. 20 marks to 25 marks. Examiner can examine most chances with the section C and section A. Very least chances about section B, but it's possible. To remember one point about this, you have to prepare working capital, although prepare all the topics very confidently, but also the working capital management. You have to spend a good time on working capital management because of two reasons. Number one, examiner is very much keen to ask this topic because in advanced level of financial management, this topic has almost no role. If you study investment appraisal, FM, advanced investment appraisal, AFM. Risk management, FM, advanced risk management, AFM. Acquisition, merger, business valuation, cost of capital, FM, advanced levels, AFM. But working capital, almost no. Not even one, max, not even 1%. So that's why the main examination context about the working capital or the main playing field for examination is this FM. So this is this statement not considered only as a fair, but as an opportunity. It's not a threat, it's an opportunity that you can grip. You must have to make a grip for all the topics here. Take a good working now. So that's the importance of this topic. Working capital management. Um, Number one, you have to make a list what to do for this. Number one, you have to know what is the working capital meaning, its purpose or objective. Whenever you started, you have first of all cover what is the meaning of the working capital. Working capital means day-to-day activity finance requirement. It can be explained current asset minus current liability. It can be explained with respect to cash operating cycle as well. Okay, that's good. So you must have an ability to explain your answer the meaning of working capital. Number one. And if the marks of the meaning of working capital more than 2 or 3, or if examiner particular mentioned to explain the purpose or objective of working capital, you have to explain the working capital management is to maintain the liquidity to support the profitability of the business, to support the continuation of the profitability of business. Objective means, here the objective, profitability, and number two, liquidity. But at that moment, when you maintain the liquidity and also the profitability, there is a conflict between them. There is a conflict between them. There's a conflict between them. Whenever to maintain the liquidity, you have to invest the fund, for example, bank OTs. So maintain the liquidity, you have to put the interest. And for the sake of it, whenever you're putting the interest, that means your the profitability having negative effect. Having negative impact. So that's the point. Then, very important thing, you have a good grip about the working capital, the calculation, initial calculation about ratios, all working capital ratios, means current ratio, quick ratio, cash operating cycle, straight cash operating cycle, you must have to know, and the reverse working as well. Means, for example, account debtors collection days. How to calculate? Receivable divided by credit sales multiplied by days or weeks is equal to debtors days. That's straight working. But you also know the reverse working as well. If you sometimes, if days are the targets, 365 standard rate, credit sales, so what should be the receivable? That's important. That's very much important. Same for payables, sorry, inventory, same for payables. So ratios, cash operating cycle, all. Then now listen some theoretical aspect very importantly. Theoretical aspects very importantly. Working capital management. And these are different components now. Means, let's suppose cash management, receivable management, payable management, inventory management. These are the aspects you have to enter with this. Now one by one. Candidates, before starting anything about the working capital management, listen carefully. We have already discussed one important point. Why do we need finance? Means finance always required in a justified manner. Finance must be worked out in a very justified manner. What does that mean? What does that mean? Very important discussion I'm working here. Tamina, I will reply you later on. let's suppose I required a finance. Sorry, I required a finance for non-current asset. That is long term. So the finance we are available, that's debts and that's equity. Equity is a long-term finance and debts has two categories: long-term and short-term. Long-term, short-term. Short-term trade payable, short-term bank OD. Long-term bank loans, debentures, like this long-term. You know very well. If I say that non-current asset, that is long-term, if we need to invest the money for non-current asset for long-term, that must be matched with long-term. Long-term with long-term. But I'm saying long-term must be matched with long-term. Huh? But I'm not saying that if I need the money for short-term. First of all, what is the meaning? The need of money for short-term. What does that mean? What does that mean? The need for money of the short-term. Let's take an example. You need car, short-term or long-term? That's long-term. But for the sake to run the car, you need fuel, you need maintenance. So maintenance and fuel is also the purpose of the finance. Once again, with different example. Nestle wanted to launch another product. So finance required to establish the machine, to establish a setup of machines, building, land. That's long term. But finance also required for short term as well. How to run the machine by fuel, by raw material. Because the business cycle is this, we will purchase the raw material, number one. We will inject the labor, we will inject the overhead, material, labor, overhead. Three things combined, run the thing, run the system, then sell to the business. Sorry, sell to the customer and collect the money. Ideally, all the business should be on cash basis and inventory should be JIT. What does that mean? Number one, I will not pile up the inventory. I will not hand over credit to anyone, customer. One customer will come, pay me the cash, I will purchase the inventory, I will purchase the raw material, labor, overhead, purchase and process it, pay to the customer. This is not realistically possible. This is not realistically possible. You know what I'm saying? In the real world, we need to maintain the inventory. We need to maintain the receivable. So actually, working capital is sorry, required for the purpose of inventory and for the purpose of receivable. This is what the short term. This is short term. This is what here we are discussing why we need finance, need of finance. We need the finance for short term for inventory receivable. So the very first point, how to arrange the short term. How to arrange with this short term? We will arrange this short term finance, some of the part related to short term and sum of the part related to long term. It's a combination. So candidates, very important thing, listen here. This portion you have to study accordingly. What is working capital investment policy? And here you have to consider what is working capital financing policy. I'm giving you complete briefing of the topic. You just pick up the book and kids or the past papers, attempt it accordingly. With this platform, with this platform I'm giving to you. If examiner asking you working capital investment policy, that is the meaning. That what are the policies we have to develop? Whenever discussing investment policy, mentioning the question investment policy depend on behavior or risk attitude of businessman who run the business. There are three possibilities. Number one, conservative policy. Number two, aggressive policy. Number three, moderate. Conservative policy means in working capital investment, working WCI, working capital investment should be higher. Means pile up more inventory, giving more customer to credit. That conservative policy. Aggressive, working capital investment should be minimum, lower inventory, lower receivable. Examiner can ask you, JIT system is the reflection of aggressive? You will answer yes. All advanced manufacturing environment where inventory will be minimum, that's called aggressive. That's called aggressive. They were taking less risk. They were taking higher risk. Risk lower, conservative. Lower risk, return will be lower. Here return will be higher. Moderate, mid policy. What is the meaning of working capital investment policy? Means how much working capital investment, means inventory and receivable should be maintained. That's called investment policy. The behavior, it depends on the behavior, conservative or aggressive, having different reflections. Are you with me? Candidates? Next point, candidates, next point. Working capital financing policy. That from where we arrange the working capital finance, from where we will arrange the working capital finance. Some very important thing you have to consider before finance. You have to consider one important thing. If we are more reliance on short term means bank OD, let's suppose bank OD, more reliance on bank ODs, then we are very much riskier. As we higher reliance on long term, That's very less riskier. Now listen, working capital financing policy also depending on the behavior. 3, conservative, moderate, aggressive, but don't mix it. Entirely different. This is finance. Conservative, more about long term. Aggressive, more about short term. Moderate, balance. Risk, lower. Risk, higher. Return, lower risk, lower return. Return, higher. Moderate, equalize. You have to know one very important thing here. This in now connecting investment and finance. Now connecting investment finance. Listen here. This short-term investment categorized into two formats: permanent and fluctuating. Permanent current asset, fluctuating current asset. Permanent current asset, fluctuating current asset. Permanent current asset, fluctuating current asset. Permanent means stable, anytime, without seasonal variation. For example, you have a superstore, but during the festival time, your inventory requirement increase. For example, a complete year, 2 months time of the festival in your culture. 2 months inventory level higher. Rest of the months flat. That's fluctuating. That's permanent. Flat means permanent. Fluctuating means variation, seasonal variation. Normally, if we say that, listen carefully. Long-term non-current asset match with long-term, permanent with long-term, fluctuating with short-term. I repeat, non-current long-term match with long-term finance, permanent current asset match with long-term, fluctuating match with short-term finance. Means we are putting less with risky. Normally, it's a moderate approach. But listen carefully. If we are aggressive in nature, we will very much concerned. Sorry. If we are aggressive in nature, so we are very much concerned for the short term, means arrange the majority working capital with the short term. It's a very risky candidate. Do remember, bank overdraft, short term majority based on bank OD. Bank OD is riskier than bank loans. Why? Listen carefully. If I ask you to take up a 1 lakh loan for 5 years, that is long term. On the other hand, take up 1 lakh bank OD, maintain with 3 months time. Means every 3 months you have to show to the bank. So which one is more riskier? Definitely bank OD. Because bank loan, you don't need to show the amount to the bank. Number one. Number two, bank OD is more riskier. More riskier means you will take up the loan when required. This is the advantage, as already discussed yesterday. But bank loan, either need or not, you have to pay the interest. Number two, bank OD customized interest rate is higher, but overall interest cost is lower. Overall interest cost become lower. Bank OD overall interest cost is lower. Bank OD overall interest cost is lower. That's my highest return. So one important thing, listen carefully. If managing the working capital finance and more reliance on short term, less reliance on long term, that is, we are aggressive. On the other hand, if we are very much maintaining the working capital financing policy, very much reliance on long term, very much reliance on the long term, then this means we are very much conservative. This is the most important thing that's I have discussed with you. Now, something important, move on. Candidates, I must say, I will share you this document with you, this one, this analysis of the Kaplan. I will share you after the session for this, the attitude of the management risk. You have to cover theory and must have to, this is not a question, this is just a reading. What will be the impact if you are aggressive? What if you are aggressive, your return will be higher. Conservative, lower return. You are aggressive, your interest will be lower. Conservative, interest will be higher. Current ratios, what will the impact on the current ratio you have to consider? If you are risky, this is current ratio. Less risky, this is current ratio. You have to consider it. So now, furthermore, moving forward, this is what a briefing of the topic. I hope that you are getting some, you will get some advantage by this lecture. 10 to 15 minutes more for this session. Candidates, furthermore, if you enter with the working capital management, you go for the receivable management. Make your direction. What is the meaning of working capital management? What is the meaning of the working capital management? Working capital management means management term. Management means control. Working capital management means you have to control the working capital required days, means whatever you need. If you plan that the receivable will receive 30 days, so you have to receive within 30 days. That's management. Number two, receive the management within 30 days and maintaining your receivable related cost. Maintaining your receivable related cost. So first of all, you have to consider what are the receivable management cost. So you will consider that is admin cost. There is admin cost. Receivable management, chances of bad debts. If you manage a receivable, you will offer the discount. If you manage a receivable, then factoring cost. These are the receivable management costs. And of course, the very important thing, the finance cost. You have to consider important thing, analysis about three things. These are theory, huh? This is theory. You have to cover this matter as a theory. You have to consider one important thing. credit policy how to minimize the receivable management cost. This is also theoretical aspect. Number one, evaluation of credit customer, evaluate, ranking, aging. Once again, offer discount. Once again, factoring. This is also theory. You have to, examiner can ask. And number three, then you move for the calculation aspect. What's calculation aspect? Evaluation. Number one, if you offer discount, then evaluation. Factoring, we have a limitation of time. Otherwise, I will solve a question of factoring. Factoring, I will give you a question structure to you on the WhatsApp about the working capital management. A question metrics of the working capital. You can work out accordingly. Past paper wise. Factoring and evaluation about extension of credit terms. This is evaluation. And this is what? Calculation. This is important. And don't ignore other theory matter. For example, you have a good command on the term to explain invoice. What is factoring? Factoring means you will appoint a factor, and what the factor will do? Factor will provide you two services. Number one, correction of receivable. Number two, advance. Provide advance. This is factoring. What is invoicing? Invoicing means you just select an invoice of a reputable customer and sell that invoice of the receivable to the bank. Bank will evaluate your creditor, the reputation of the creditor, for example, 1 lakh credit value, and you will get the money from the bank, for example, 98,097. So this is invoicing. If you need the money, you can sell your invoice. Factoring is not invoice by invoice. It's a bulk matter. Invoicing is based on individual sale or out individual sale of invoice and collect the money from the bank. The difference between factor and invoicing is, in invoicing, the collection of receivable not belongs to the bank. You just sell and receive the money of the customer. When customer will pay you, you will hand over to the bank. Invoicing and international receivables, forfeiting and like this, you have to cover it. Now, candidates, furthermore, you have to cover the payable management. Number one, evaluation of accepting credit. One thing. And foreign payable. Examiner can ask you some foreign payable, and you have to evaluate forward or money market payable management. And candidates, very important thing, cash management. That is cash budget. You have to know that's calculation. Cash budget and cash management models like Miller or and PML. You have to consider, and including this, the theory, treasury management. Candidates, listen carefully here. Treasury management. Treasury. Whenever you have surplus cash in your fund, you have to invest for some time period. Surplus. But surplus cash invest for some time period, but you have to consider important thing. Three things you need to consider. Your surplus cash need to invest for short-term time. As you need, you will collect it. That is, first thing is the liquidity. Number two, profitability. Means you will invest in a way where profit is expected. And safety, less chances of loss. That's why cash stock market is not feasible, because not safety. There is an MCQs about it. If you are not if not getting this point, you must have to access this lecture recording and rewind this point what I say to you. Treasury management and candidates, working capital management, very important thing I'm writing here. They are the case and need to identify the things that is about over trading. Overtrade means you have a limited finance, but you are working with a huge business. That is overtrading. Examiner can ask you to determine the symptoms of overtrading. It's a common question. June 16, you have to attempt the question. What are the symptoms? For example, if candidates, listen carefully, if a company's sales move, if the company moves, ideally working capital also injected. Otherwise, if you're not injecting the working capital, that means you are overtrade. With overtrade means working capital lower, you are working more business. That's a dangerous situation. Sales rapidly increase. Symptom, you have purchased the non-current asset. Symptom means need to diagnose. It's not confirmed that overtrading happens. If you purchase the non-current asset, not inject not inject the working capital, that means overtrading. Your receivable and inventory become increases. You mismanage the business. Your inventory is on not the right time. Sorry, receivable not the right time, inventory not sale in the right time. That's a symptom of overtrading. And you have to refer the book for this. Refer the book and then solve this question. Overtrading. Same case, overcapitalization as well. But this is not danger. Overcapitalization means you have invested more money as a working capital. Candidates, that is all I have done. I have put it my maximum effort. I have have done a full effort with you for this prepare to pass exam with all of my heart and soul. That points, and that's the maximum I can done for you. Thanks for the ACCA, and I hope that these sessions are very valuable for you. If you need any workout, anything more, you have to contact me on the WhatsApp. My WhatsApp number is 030092132182717884. You can WhatsApp me. In future, you required FM or other than FM, AFM, SBR, like any subject you need to consult with me, you can contact me, and you can get all the things on the WhatsApp as well. All the links available on the Vimeo. Candidates, last 1 minute, last 1 or 2 minutes. Do remember one thing. Um, do remember one thing. Whatever the sketch I have designed with you, that is not traditional. That is not the rote learning. ACCA body is very much concerned to facilitate the students and try to eliminate the concept of rote learning. Because in the real world, whenever you go for that screen for the examination, the things are not 2 plus 2 is equal to 4. The learned things will not useful in any way. Based on that matter, I have delivered the things, conceptualize, exam focus. I must say to you that you must have to read the mind of FM maker, FM examiner from the ACC website. You must have read to at least at least 2 to 4 examiner report of the 2019, and must have to attempt the past papers, at least 4 past papers. If you need any more support, do let me know on the WhatsApp group. Link already shared with you. And I really don't want to leave at that point, but time is limited. Thank you very much. Take care a lot, and Allah Hafiz. Alhamdulillah.